Welcome to Opal's TV. Today I'm in Geneva together with Stephen Markowitz. He's the co-founder and head of research of Lake Geneva Investment Partners. Lake Geneva Investment Partners was founded in 2008 and is a Swiss FINMA regulated asset manager. But Steve had been in the industry for many years. So Steve, please give us a quick rundown about your career.
I'm from New York, born and raised there, and started my career writing software for Knight Ridder Company. It was a software house. Very quickly I moved on to the larger banks, Deutsche Bank and Bankers Trust, where I was writing software and writing quantitative models for traders and for the trading floor. My passions moved me pretty quickly more to the trading side, more to the model development side, and I ended up spending a handful of years with Millennium Partners in New York. In 2007, I left to Geneva to be a co-founder of Lake Geneva Investment Partners. We launched our first fund in 2008, April.
Okay, Steve, you spent 5 years with Easy England at Millennium Partners. How has this influenced how you trade today?
Millennium is one of the finer shops with one of the most storied track records in the business today. And one of the things I learned there was if you don't have an advantage, get out of the markets. The markets will punish those who don't have an advantage. And the more dispassionate, the more rigorous you can be about your models, about your stop loss, and knowing truthfully what advantage you have and capitalizing on that, the better off you'll be and the more long-lived you'll be in this business. We carry some of those lessons learned in the early years to what we're doing here at Lake Geneva Investment Partners. We know the advantage we have in the markets, or we like to think we do, and we build that intelligence into our models. We're not a global macro shop with big opinions on the direction of interest rates or whether Facebook or Apple are fairly valued. We take small bets or even concentrated bets for short periods of time. We're picking pennies up off the floor, putting our most intelligence into the models and trying not to let it interfere with statistical advantage we believe we have. The models have naturally bifurcated themselves into different markets. Some of the models ended up in the fixed income space where we've packaged the model into a fixed income fund, daily liquidity UCITS wrapper for general consumption. The equity markets are also a place where our models are actively practiced. We have a hedge fund that's offering weekly liquidity with a Cayman wrapper. That fund offers a series of models operating at different frequencies, trying to capture and extract returns in the equity space.
So Steve, I know your equity long-short fund isn't really a typical equity long-short fund. In fact, it's much more than that. So tell us more about it, please.
Our equity hedge fund is a tricky beast. It has longs and shorts inside the fund, but it has none of the performance characteristics of a typical long-short fund. A typical long-short fund might be correlated 0.7, 0.8, 0.6 with MSCI World Equity or with S&P, and our correlation is 0.2 or even 0.15. Even over a number of months, we're negatively correlated. We have models and we have a fairly dispassionate approach to trading, but we're not systematic either. We don't systematic in the sense that we're not CTA-like with huge trends and huge periods of excessive return and huge drawdowns the way CTAs do or the way other systematic shops do. So we're not animal, we're not vegetable. I'm trying to find the good mineral that we are. The end result, or the good mineral label that we are. The end result is a fund whose volatility is very well controlled, who launched itself in 2008, who was positive in 2008, 6%, and who lifetime to date has exceeded by 40-something% the HFR index over the same period of time. Halfway through our life, our young life, around 2010, we were challenged with coming up with applying our techniques to the fixed income markets. And some investors had wanted us to launch a managed account and subsequently a fund using some of our techniques in the fixed income markets. We did, and the end result is the Fixed Income Allocator, a fund with approximately $350 million in assets. As a performance measure, has outperformed its respective benchmark by about 15% lifetime to date. Candidly speaking, anything being long fixed income over the years was an easy trade. Being long, being strong, every selling opportunity was meant to only buy more, was the modus operandi for the last 3-4 years. At this point, at the time of this interview, things are getting a little trickier. Most fixed income funds are flat or negative on the year. It's getting more difficult to navigate fixed income markets. We believe we have a method to do that. The fund tries to capture trends in a very unique way, is very quick to exit trends that are failing or faltering, and very quick to jump on trends that establish themselves. If you know that German bonds yield will go back to 0%, by all means go levered long German bonds. You don't need us. If you know that the Fed for sure will raise rates and that the long end of the U.S. curve will be at 3 and 4 and 5%, by all means you don't need us again. Go and short some futures. In absence of knowing these things, you need to be able to rest easy at night, or try to rest easy at night, with a manager or with a system that has a methodology about trading the markets. Whether they make money or not, but at least a system that dispassionately makes sense and tries to capture returns. That's what the fixed income allocator is trying to do. One of the things we strive to do is deliver returns that an investor can take advantage of. If a fund manager is up 50% in 1 year, but you're not invested, you're not advantaging from it. If a fund manager is up 50, but en route to being up 50, he fell 25, and you sold, and then he made 75 or something like that to be up 50, you didn't participate. Those are examples of year-to-date numbers that look attractive, but are really not able to be enjoyed and profited from by the average investor. The average investor decides to buy with his intellect and sells with his gut. If the volatility is too great, the investor will leave. It's just how it goes. At LGIP, we try to deliver our returns, however boring they may be, whether it's +2 to +11%, in a package that you can digest, that you don't wake up in the middle of the night and say, I've got to sell this. Point in case. There was a fund run by a fantastic manager called Ken Hebner. Ken Hebner is a known U.S. long-only stock manager, and he ran a fund called the Clipper Fund. Clipper Fund was a long-only S&P-like fund, but Ken Hebner didn't care about tracking the S&P. He took very concentrated bets on sectors. Ken Hebner had a very long track record, and a successful track record of being the S&P. 1 year he didn't do very well. He got it very much wrong. So the Clipper Fund has this lifetime to date chart where it goes from 100 all the way up to 1,000 and a very sharp fall down to 500. There was an analysis done by Morningstar that talked about the average investor return investing in the Ken Hebner Fund. You might think, oh, it's quite positive. The fund was up this much, probably it's 11% a year. The average investor made 11% or 5%. The average investor lost money. The average investor lost money in Ken Hebner's fund, an astoundingly good fund for a decade. And in fact, it was the top performing fund for a decade. But because of the sharp fall, most investors had gotten in right near the peak of his performance, i.e. performance chasing, another pitfall that investors fall into, only to have them have whatever gains they have completely wiped out by the very sharp and rapid fall in the months that ensued. So it's an example of a fund, a known fund with a good long-term track record, run by a good manager and a well-established fund company, the average investor having lost money. It's because of the volatility. You must deliver the returns, and this is our challenge, deliver returns in a package that helps the investor, that allows him or her or them to stay in even during the tough times. Control volatility is something we believe in. not only gives us longevity, it allows us to sleep at night, but it allows our investors to sleep at night. And an investor withdraws from the fund due to his losses. It's not good for him, and it's certainly not good for us. It's just a more moderate way of, a more controlled way, a more reasonable way of being long-lived as both investor and investor manager. The same with long-only mutual funds, the same type of behavior seen in hedge funds as well. Strategies come into vogue, whether it's CTA or long-short or macro, money comes piling into the strategies. Successful managers have one last flurry of success only until they fail or the strategy fails, and investors are left holding the bag. Investors are performance chasing. It's a very difficult thing to fight against, but you must fight against. On the investor side, you must not performance chase, and on the manager side, you must control your volatility. Investors performance chase, and no matter what the strategy is, no matter what the ETF is, anything that gets too crowded will eventually fail. Whatever gets too crowded will have an explosive period of unwinding, whether that's a market like China or an ETF like the VXX or a manager. Too much money, too many people on board. The markets are not democratic. We don't all deserve to make money. Punishment will be felt, and the explosive unwinding results in money losses and results in extreme volatility. And that's the purging that happens in the markets. There's no regulation that can control that. It's the nature of the beast.
Steve, tell us, how do you do your portfolio management and your risk management?
In our equity fund called the Velocity Fund, there are 5 different models running at the same time. One model may be making money, one model may be losing money. One may be long equity and the other may be short equity. They're running independently with their own frequency and generating trades on their own with their own frequency. On top of that suite of models, there's a look to the overall level of volatility of the portfolio. So if the returns of the portfolio, up or down, exceed a certain targeted, self-imposed targeted volatility, the risk management process has to cut back positions equally across all models. So the nature of our returns, or rather the controlled nature of our returns, can be seen in that our drawdowns generally are de minimis, and the returns we generate are delivered in a package that can be digested by the investor. August was a particularly proud moment for us. August, many hedge funds were down sharply. Markets, whether it's MSCI World or S&P, were down sharply. Bonds, high-yield bonds, were also down sharply. Investment-grade bonds, normally a safe harbor during tumultuous month, were in fact at best flat. Bunds, in fact, were negative. Treasuries and 10-year were marginally positive, almost flat. August was a proud moment for us. We generated about 1% positive return. The models and the fund thrive in volatility. That's really as best as I can say it. If I were to choose the best market environment for us, it's volatile markets. The models need dislocation. The markets need equities moving sharply in one direction and then reversing. The markets need VIX spiking up and then coming down. The models need dislocations between asset classes and dislocations between ETFs for us to make money. We made our most money in 2008 and 2009. Returns have been still positive but diminishing since, as volatility has come down. So we welcome a return to more normal levels of volatility. That might be VIX at maybe not 40 or 50 on a spike or 30 on a spike, but a level of realized vol in the mid-teens where normally had been 10 and less. Those are welcome times for us.
So I think a lot of investors have an appreciation about your models, and particularly about your performance and about your uncorrelation. I wonder, once you take on an investor, what's the degree of transparency you give them? That means, how open are you sharing the models with your investors?
We welcome all investors, of course, but we also welcome investors' questions about transparency. To the point of being as transparent as we can, we've made liquidity daily in the fixed income fund and weekly in the equity fund, such that should you have any questions whatsoever, you can leave as quickly as you come. Aside from that, reports are produced daily by the administrator, and we share with you our full positions should you so wish. We also share positions in our equity fund with the same frequency. We have no secrets. We're entrusted with managing something very precious to you, and so the flip side of that is to share exactly what we do and how we do it, line by line if needed, with the inquiring mind. Another thing that investors have learned to appreciate about our fund is the nature of the liquidity of our underlying investments. All our instruments can be liquidated within a day, such that the entire portfolio could be liquidated within a day. The gains that we show at the end of a year are, for the most part, realized gains. 92%, I think, last year in our equity fund were realized gains. They're not gains from mark-to-market positions held, nor are they gains from pricing securities that are perhaps not so easy to price, but have a generous price at the end of the year for the fund. The time for the independent asset manager who can perform and who can be regulated and who can be transparent and who can show liquidity is here. We think we do that here. We think we check the box in all manners of speaking, and it's not easy to do that.
So Stephen, tell me more about the outlook that you have for your funds and your models. I mean, we talked about volatility. A lot of people think that volatility is coming back to the markets. We are now in mid-September of 2015. We will see what happens for the remainder of the years. But there are quite a number of people who say that the one-way street of a 7-year bull market may soon be over and that volatility comes back. So how are you set up for that?
The good news for investors is that my opinion doesn't matter which way the markets are going. We try not to have an opinion whether markets are going up or down. We try to be prepared to capitalize on the volatility within the markets. The ideal scenario for us is if markets are sharply down or sharply up, we try and capture that momentum. As example, in August of this past year, our performance was sharply positive. We try and capture the volatility that the market offers. In 2011, in 2008, those are our best returning months and quarters just when the world was falling apart. By targeting volatility, we managed to navigate some of these pitfalls. By sticking to our knitting, you don't find positions based on opinion, you find positions based on a statistical anomaly. By reducing volatility regardless of the reason, positions are cut. And by admitting you don't know something. We don't pretend we know which way interest rates are going, and there won't be a position in the book that reflects that. Any pundit that tells you, whether it's from a hedge fund or a CNBC talking head or a bank that says the U.S. is doing fine and rates will go here, knows no more than you do, and it's as good as a coin toss. And if you're managing money based on that, your returns will be market returns with market volatility. They won't be above market returns with below market volatility.